The stock market controls so much of our global economy and impacts our lives. There are 80 stock exchanges across the world, with a value of over 100 trillion US dollars. But do you know where the concept comes from? In this video, we dive into the history of the stock market. We start in 14th century Venice. Its narrow winding streets were full of merchants and sprawling markets trading exotic commodities. It was now the most prosperous city in the whole of Europe, and the Venetian Republic was expanding, not just militarily but innovating the world of finance. Merchants dressed in silk robes and lavish jewelry clutching slates for record-keeping held meetings in the markets. They were no longer trading goods but were buying government securities, trading loans, keeping records and controlling much of the trade in the Mediterranean. The financial markets were beginning to gather pace. By the middle of the 14th century, they became significant enough for the government to start introducing regulations around the concepts of what we now would call market manipulation and insider trading. In 1851, spreading false rumors with the intention to reduce the price of government bonds became illegal. As the financial markets grew through the 14th century, more regulation was introduced, but it didn't deter the rise of capitalism across Europe. The rest of Europe took notice quickly, and by the 15th century, similar financial trading of government bonds became prevalent in Genoa, Florence, and other parts of Italy. Trade fairs across Europe not only started to feature financial market traders, but those small groups of traders began having a huge influence on these fairs. Traders from across the continent flocked to cities with regular trade fairs, and some made Antwerp their home. Antwerp was now becoming the heart of financial trading with almost year-long fairs in the city. It became the first city to boast a stock exchange in the mid-16th century known as Bourse. Capitalism was starting to take shape. European empires were expanding, conquering new lands, and acquiring gold at a fast rate. Trouble was afoot. As the supply of gold and silver increased, inflation took hold, and prices began to rise across Europe. The end of the 16th century was fraught with wars, and as the Spanish troops advanced toward Antwerp to impose the Inquisition, finance experts fled, and this brought about the abrupt end of the Bourse and Antwerp's sprawling financial markets. The refugees from Antwerp had found a new home in Amsterdam, Netherlands by the start of the 17th century, and brought with them their financial wisdom. In the Netherlands, the Dutch had declared independence from Spain in 1581 and needed to fund their trading endeavors in the Indian Ocean in times of rising costs. This need, combined with the wisdom of possibly the refugees that arrived from Antwerp, led to the formation of the Dutch East India Company in 1602. The company was to be unique, the first of its kind. To manage its cost, the company would sell shares to the public, raising capital for their risky ventures in the Indian Ocean, and in return sharing the profits with investors in the form of dividends. As the investors were not partners, they couldn't simply demand money back from the company. If they wished to recoup their investment, they would need to sell their shares to a willing buyer. To enable this new form of trading shares, the Amsterdam Stock Exchange was created alongside the Dutch East India Company. This was effectively the first of modern-day stock exchanges. The company was consistently profitable and began attracting capital from across Europe. Amsterdam had now become the new financial hub of Europe, and the market continued to grow rapidly throughout the 17th century. Not only were people able to buy shares, they could take out loans to invest, trade commodities, trade futures, and buy or sell insurance. Throughout the 17th century, the Dutch financial method spread through Europe, but so did wars. The success of the Dutch East India Company had shown monarchs a new way of financing their wars, and London in particular was taking notice. As William of Orange ascended to the English throne in 1688, capitalism was starting to take hold across the country. Traditional beliefs were changing. Profits and interests were once frowned upon, but now were being seen as beneficial to society, and new money was spreading through the nation. In the 1690s, coffee houses in London became the informal trading spot for stocks and shares. Brokers could be found in the narrow streets known as Exchange Alley. 1694 saw the opening of the Bank of England, and its shares were traded alongside the East India Company. The London Stock Exchange was becoming an international phenomena. Companies from other countries were being floated on the exchange. But things were about to go wrong. With constant wars and new currency notes issued by the Bank of England, mixed in with alleged greed and manipulation from brokers, people started losing confidence in the market, causing a crash in 1696. The crash was short-lived, but devastating to the market. 70% of publicly trading companies did not survive and make it to 1697. The government sprung into action going after brokers. They introduced new regulations requiring brokers to acquire licenses. Commission rates were curtailed, and a limit on the number of brokers was introduced. The market quickly recovered in 1698 and continued to grow its influence on the English economy. We now turn to Paris in the 18th century. The country was in economic turmoil. Unlike the Dutch and English, the monarchy was clinging on to full control of the economy. But as conditions worsened, the French turned to a Scotsman by the name of John Law. Born in Scotland, John Law had been exiled from England as a deal to get off on a murder charge. A notorious gambler and a charming man, Law had his sights set on a piece of capitalism brewing in Europe. After a short time in Amsterdam, he set off to France where he formed the General Bank with the help of the French monarchy and replaced the limited French currency with the less resource-limited paper notes. Law then went on to create the Mississippi Company in 1717. Using his influence on the monarchs, he gained exclusive trading rights to the French colony of Louisiana. In return, he concocted the ingenious concept that would help him raise capital while helping the failing finances of the French government. Law allowed shares in the Mississippi Company to be traded for government bonds, and in return for the trading rights he accepted a lower rate of interest on bonds owned by his company, a lucrative venture for all. Law soon expanded his empire, taking over trading rights for all French colonies, and slowly buying out parts of the French economy in order to boost share prices of the Mississippi Company. Funding his purchases with loans from the state bank he once owned, Law had gained a strong grip on the French economy. His plan was working, and by 1719 the share price for the Mississippi Company had rocketed by more than 10 times its original value. Law now owned the national debt and large parts of the French economy, enough to control interest rates and influence the economy, and the French government reaped the benefits as the economy began to boom. Luxury items lined the stalls of French markets, trade was booming, and the public was getting rich off the Mississippi Company. Word had spread to London, where fears were beginning to grow as money that was previously in the London stock market was now flowing into Law's new economic model in France. Desperate to replicate his success, the British formed the South Sea Company. The company was to use Law's model to trade national debt for investment in the firm, and in return gain exclusive trading rights with Spanish America. Much to John Law's glee, who held resentment towards the British, the South Sea Company failed to deliver on its promise of riches to the English. The Spanish colonies were not open for trading with foreigners, and the share price of the South Sea Company took a nosedive. The tables were finally turned in 1720 when the Spanish made peace with the British, and South Sea Company shares started to take off on mere speculation. While across the channel, Law's greed was starting to bear its ugly head. He had successfully dropped interest rates and flooded the markets with paper money, offering cheap credit to help sell shares in his company. We now know where this was leading. The drop in interest rates and introduction of paper money led to inflation and sent prices soaring. The French lost confidence in the Mississippi Company and the new paper currency, as they sold in panic, sending shockwaves through the French market. Law grew desperate in his attempts to save the company he had started. With full control over the French economy, he tried to stop the export of coin, enforce paper currency, but all of it was in vain. Money flew out of France and into the London Stock Exchange, amongst others across Europe. The French began to riot, turning on the government and Law. Mobs hunted for Law, attacking his house and carriages. Law eventually escaped to Venice. In England, the South Sea Company was flourishing, and new businesses were being floated on the stock exchange, pushing the value of the exchange to £500 million in 1720. England was now seeing the short-lived boom France had experienced. Credit was flowing free in the markets. It seemed like everyone in the country was getting rich. Just like France, this was short-lived. As conditions worsened in France, panic selling started in London, partly driven by French investors wanting their capital and gold back. The South Sea Company, much like John Law, used its influence on the government to restrict trading to only licensed businesses. The company was still not able to trade in Spanish America, and relations with the Spanish were beginning to deteriorate again. Despite the lack of any real revenue, the company continued selling stock, effectively become what we would call a Ponzi scheme. In desperation, attempted to buy more government debt and sell more shares at a profit to pay dividends to its shareholders, many of whom had bought their shares on credit and now were saddled with debt. The bubble eventually burst, and its impact led to the collapse of financial markets across Europe. Greed and corruption had led to the crash, and throughout the 18th century, European governments worked on legislation and regulation to prevent future disasters. The South Sea Company survived the crash, but in name only. Losing its trading rights later in the 1700s, the company became a subsidiary of the Treasury and was eventually dissolved in 1854. Laws of the 18th century financial market still exist. The same bull runs, overstretched lending, Ponzi schemes, and government complicity has repeated itself over and over again. We will cover the 19th, 20th, and 21st centuries in part 2 of the history of the stock market, so don't forget to subscribe, and thank you for watching.